Pfizer stock has been going down tremendously in the past year or so, with the stock down nearly 50% year to date. The drug giant has been hurt by a variety of different issues, the main one being a slowdown of revenue coming from COVID vaccine sales. The current outlook for the stock going into 2024 has also hurt the stock price, as Pfizer recently announced poor 2024 earnings guidance. Due to this, the current share price is just around $27, the lowest it's been since 2013, and the stock now yields just over 6%. That being said, is Pfizer a good high-yielding stock to pick up for the turnaround, or is this a dividend trap that will keep spiraling? That is exactly what I'll be going over in this video, so let us get right into it. Before we start this video, make sure to like and subscribe if you're new to the channel, because I will be posting dividend stock videos just like this one every few days. To start with, let us go over Pfizer's business model. Pfizer is a pharmaceutical giant that primarily focuses on drug creation. The company heavily invests in research and development to discover and develop new drugs, followed by their own manufacturing. Pfizer sells these drugs using strategic sales and marketing efforts to bring its portfolio of prescription medications, vaccines, and consumer healthcare products to a global market. For example, you've definitely seen TV commercials for a Pfizer product at some point in your life, even if you didn't know it. Pfizer's collaborations, regulatory compliance, and pharmaceutical innovation are what makes Pfizer such a potent drug company, ensuring Pfizer's position as a leading player in the pharmaceutical industry. Now that we've gone a little bit over the business model, let us go over why the stock has dropped so much in just the last year. The main reason behind this is because people got used to Pfizer's insane COVID sales. Because Pfizer was the main drug manufacturer behind the COVID-19 vaccine, they profited immensely, but due to the dwindling need for these vaccines, Pfizer's revenue has plummeted. At their peak in 2022, Pfizer's COVID treatments, Comirnaty and Paxlovid, brought in $55 billion of revenue just on their own. This allowed Pfizer to post record high revenues that year of over $100 billion. Compare this to the new guidance Pfizer has just posted for 2024. Pfizer has said that in 2024, they expect revenue to be anywhere from $58.5 billion to $61.5 billion. This is a far cry from their 2022 highs, and is mainly because their COVID-related products are only expected to bring in $8 billion, which is roughly an 85% drop in revenue for these products since their all-time peak. In addition, another thing worrying investors is that Pfizer just announced that they plan to try and cut costs by another $500 million, totaling $4 billion in cost savings. They announced this cost-cutting plan earlier this year as they noticed sales were dropping. The fact that Pfizer has since announced they are planning to try and cut costs by another $500 million could signal that sales are doing even worse than expected, which has shaken investors' hopes. They are also going through their finalization of their acquisition of Seagen, ticker SGEN, for $43 billion in cash after they received regulatory approval. This is an absolutely huge acquisition that is roughly proportionate to a third of Pfizer's current market cap. This large buyout has put investors on edge again as Pfizer is burning through their cash, but generally this purchase could prove to be a decent deal going into the long term. That being said, let us talk about some of the better news surrounding Pfizer stock, starting with the Seagen acquisition. Yes, the Seagen acquisition is expensive, but this company is also one that could be worth the price. Seagen is a biotech company that focuses on the development and production of antibody-based therapies for the treatment of different cancers. Padcev, a Seagen-made bladder cancer treatment, was approved by the FDA in 2019 and has quickly become a top seller, reaching $200 million in sales in third quarter 2023 alone, which was a year-over-year jump of 89%. In September, Seagen announced success in a trial with chemo-eligible patients that will most likely result in Padcev and Merck & Co treatment Keytruda becoming the first chemo-free treatment option for new bladder cancer patients, regardless of their chemotherapy eligibility. This could be big for sales regarding Padcev and would theoretically drive revenue even higher. We should find out whether this will become a reality before May 9th in the coming year, as that is when the FDA has scheduled to announce their approval. Long story short, Seagen is currently extremely profitable, and buying the company now could prove beneficial for investors. If the FDA does approve the Padcev plus Keytruda treatment to include all first-line bladder cancer patients, then this would make the acquisition even better. That being said, Pfizer isn't relying completely on this acquisition. Pfizer still has several top-of-the-line products right now, including Vyndaqel, a drug with sales that jumped 47% year-over-year to an annualized $3.6 billion based on third quarter reports. Pfizer's current line of products, combined with their Seagen acquisition, could make it so revenues do start to trend upward. However, it is unlikely that they will reach their 2022 highs anytime soon. Also, talking about some of their COVID-related treatments, especially especially the vaccine. Even though it doesn't have the sales numbers it used to have, the COVID vaccine could potentially just become a normal vaccine that kids get, which would be good for Pfizer's bottom line. Anyways, due to the drop in price of Pfizer stock, the stock is trading at a PE ratio that is on average lower than their competitors, and their ultra high yield, which is now topping 6%, does mean that the stock would add tons of income to your portfolio. In summary, Pfizer as a business isn't going anywhere. They are simply too big. Their new acquisition of Seagen, an acquisition so large that most companies wouldn't be able to pull it off, further cements their role in the pharmaceutical industry. COVID sales are declining, and some other bad news has hurt the company, but the fact that the stock is at a 10-year low does make it an interesting play at this time. I do not recommend selling the stock at current levels. Even if the stock does drop a little bit more from here, the price is still extremely low, and due to the volatility of the stock in the past, holding it to try and sell it for a better price is probably the play I would go with personally. In addition, due to the high yield, you are still receiving good income while just holding these shares. Significant earnings growth on the back of Vyndaqel and Padcev should keep its bottom line moving in the right direction for the foreseeable future, and should hopefully return the share price of the stock back to the mid-30s or even higher at some point. I do not think I'm going to be buying any shares personally, but if you already own shares, I would continue to hold. That being said, if you think there might be better places to put your money right now, then selling the stock or reinvesting the large dividend somewhere else could also prove to be beneficial. Thank you guys for watching this video. If you agree with my take, let me know down below. But if you disagree, let me know in the comments as well. I'm super interested to hear what you all have to say. Thank you to everyone who has subscribed recently. We are slowly but surely closing in on my 1,000 subscriber goal. Anyways, I will see you all in the next video. Thank you for watching, and goodbye.